Welcome to this week's Macro Roundup, where we break down the key economic and market developments shaping the global outlook. Let's start with the United States. U.S. markets are showing tentative signs of a rebound after recent volatility, as investors rotate back into risk and reassess whether fears around AI disruption and big tech spending were overstated. That said, under the surface, caution remains elevated. Bitcoin slid to its lowest level since President Trump returned to the White House, reflecting broader anxiety around growth and policy uncertainty. Labor market data added to that cautious tone. The ADP report showed far fewer jobs added in January than expected, while Challenger data revealed the largest January job cut since the depths of the 2009 recession. Despite this, consumer sentiment unexpectedly improved to a 6-month high, largely driven by wealthier households benefiting from equity market gains, highlighting an increasingly uneven economy. On inflation, producer prices rose more than expected, suggesting businesses are passing tariff costs through to consumers. Chair Powell also indicated that the Fed now assumes core PCE inflation ran at around 3% late last year, reinforcing the message that inflation progress remains incomplete. Importantly, while the Fed controls the policy rate, longer-term borrowing costs continue to be driven by the 10-year Treasury yield, limiting how much financial conditions can be eased through rate policy alone. Globally, equity fund flows told an interesting story. Investors continued to diversify away from concentrated U.S. tech exposure, with strong inflows into European and Asian equity funds, even as total global inflows moderated slightly from last week. Turning to China. Chinese policymakers struck a more supportive tone, pledging to further open the economy and lean more heavily on domestic demand. Officials emphasized the use of artificial intelligence to upgrade manufacturing and productivity, while also committing to stabilizing foreign trade in 2026. However, the data remain mixed. China's official manufacturing PMI unexpectedly fell back into contraction territory in January, signaling renewed weakness and deteriorating business confidence. This has intensified expectations for further policy easing, with markets increasingly pricing in interest rate cuts as early as late February. While there have been some encouraging signs in the property market, including Shanghai's move to convert unsold homes into affordable rentals, funding pressures and soft demand remain structural challenges. Now to Europe. The European Central Bank held rates steady, with President Lagarde downplaying the recent strength in the euro and reiterating that inflation dynamics remain broadly favorable. Credit markets continue to reflect confidence, with euro area investment-grade spreads tightening to levels not seen since the global financial crisis. Germany delivered mixed signals. Factory orders surprised to the upside, offering hope of a manufacturing recovery. But industrial production fell for the first time since August, underlining ongoing fragilities. Meanwhile, rising government bond yields reflect growing investor concern over increased debt issuance to fund infrastructure and defense spending. In Canada, economic momentum softened further. The IV PMI edged lower, job losses re-emerged in manufacturing, and housing data from Toronto showed the steepest monthly price decline in over 2 years. Despite earlier rate cuts from the Bank of Canada, trade tensions with the U.S. are weighing on confidence. On the policy front, Ottawa is recalibrating tariffs to support domestic auto investment, while also courting Chinese-linked EV manufacturing, a move that could attract scrutiny from Washington. Finally, in the United Kingdom. UK house prices rose at their fastest pace in more than a year, pointing to tentative stabilization in the housing market. The Bank of England held rates in a narrow 5-4 vote, striking a more dovish tone than markets expected. Governor Bailey appeared comfortable with market pricing for a potential rate cut as early as March, though wage growth expectations remain uncomfortably high for policymakers. Business confidence is improving from deeply negative levels, and investors increasingly expect a gradual easing cycle over the next 2 years. At the same time, the UK is navigating complex post-Brexit trade dynamics, particularly concerns that more protectionist EU policies could sideline British firms from key supply chains. In summary, this was a week where markets looked calm on the surface, but macro cross-currents remain intense, from policy uncertainty and labor market softening to geopolitical fragmentation and uneven disinflation progress. If you found this weekly macro breakdown useful, please like the video, share it with your network, and subscribe to the channel for more insights on global markets, economics, and portfolio strategy.